Today we will talk about pay structure decisions. At the beginning of the chapter, we need to learn why pay is important from the employer and employee perspective. From the employer's perspective, pay serves as a powerful tool to advance the strategic goals of the organization. It has a significant impact on employee attitudes and behaviors, influencing the type of individuals who are attracted to and remain with the company. Moreover, pay can be utilized as a motivational mechanism to align the interests of current employees with those of the broader organization. Additionally, employee compensation represents a substantial cost for the organization, warranting careful examination. Traditionally, in order to compete based on low prices for customers, companies have resorted to paying low wages and increasing them only when faced with strong pressure from labor market competition. However, relying solely on low wages and minimal employee numbers to control costs can hinder the execution of the business strategy, potentially leading to reduced revenues and profits. For instance, it may undermine the customer experience. To illustrate, when Toyota faced slow sales at its U.S. plants, rather than laying off workers, the company introduced a voluntary buyout plan. This plan offered workers a financial package based on their years of service. The remaining employees had their working hours reduced, and they utilized the extra time for training and finding ways to reduce costs. From the employee's perspective, pay holds significance as a symbol of status and achievement. It is often viewed as an indicator of success. Employees attach considerable importance to pay-related decisions as they assess their connection with the organization. Consequently, it is crucial to handle and communicate pay decisions in a careful manner. For employees, policies concerning wages, salaries, and overall earnings directly impact their total income and standard of living. Both the level of pay and its perceived fairness in comparison to others' pay are significant factors. Pay encompasses not only cash compensation, such as salary, bonuses, and stock options, but also benefits like health insurance, paid vacation, and unemployment compensation. Considering the wide-ranging effect of pay on employees' lives, it becomes essential to manage and communicate pay-related policies effectively. When it comes to salary, decisions about salary levels can be divided into two areas: pay structure and individual pay. Pay structure encompasses two key components: pay level and job structure. Pay level refers to the average pay, including wages, salaries, and bonuses of all jobs within an organization. It provides an understanding of the overall compensation offered by the organization. On the other hand, job structure pertains to the relative pay assigned to different jobs within the organization. It involves determining the pay differences between various positions, considering factors such as job responsibilities, required skills, and experience. Both pay level and job structure are organizational characteristics rather than individual employee-specific decisions. They reflect the organization's approach to compensation and the relative value placed on different roles within the company. When discussing the consequences of pay decisions, it is crucial to understand that employees often assess their pay in relation to that of their peers. This concept is known as equity theory, which suggests that people evaluate the fairness of their situations by comparing them to others. For example, if two workers with unequal contributions receive equal pay, it is likely to be seen as unfair, particularly from the perspective of the worker making the stronger contributions. According to equity theory, individuals compare their perceived outcomes, such as pay, benefits, and working conditions, to their perceived inputs, such as effort, ability, and experience, in relation to those of a comparison other. This comparison forms the basis for evaluating fairness in terms of compensation. Equity theory has important implications for managing employee compensation. It suggests that employees evaluate their pay by comparing it to what others are paid, and their attitudes and behaviors at work are influenced by these comparisons. Furthermore, employee perceptions play a crucial role in determining their evaluation of fairness. It is not enough for management to believe that employees are paid well compared to other companies. What matters is how employees perceive their pay in relation to their peers. Employees may have access to different information or make different comparisons than management, shaping their beliefs about fairness in compensation. Okay, now let's discuss social comparisons of pay. Here, we have two types of comparisons: external and internal equity. External equity focuses on comparing the pay of employees in other organizations who perform the same or similar job roles. These comparisons can significantly impact the decisions of job applicants when considering job offers and the attitudes and choices of current employees regarding their tenure with the organization. Market pay surveys are commonly used by organizations to gather data on external pay levels, which helps determine the appropriate pay level for a specific job. Internal equity, on the other hand, involves comparing the pay of employees within the same organization. These comparisons can occur between employees in different job levels, skill areas, or product divisions. Internal equity comparisons can influence employees' general attitudes, their willingness to transfer to other jobs within the organization, their motivation to pursue promotions, their inclination to cooperate across different roles or areas, and their overall commitment to the organization. Job evaluation is the tool organizations use to assess and establish internal job structures that support internal equity in pay. Both external and internal equity comparisons play a crucial role in shaping employees' perceptions of fairness and satisfaction with their pay, which in turn can have significant implications for their engagement and retention within the organization. This table illustrates two types of employee social comparisons of pay that are particularly relevant when making decisions about pay level and job structure. Firstly, external equity pay comparisons involve comparing the pay of employees in other organizations who perform similar general jobs. These comparisons can significantly influence the decisions made by job applicants when considering job offers, as well as the attitudes and decisions of current employees regarding whether to remain with their organization or seek employment elsewhere. The organization's choice of pay level directly affects how its employees compare their pay to that of external counterparts. Conducting market pay surveys is a common administrative tool used by organizations to gather information and make decisions about pay levels. Secondly, internal equity pay comparisons focus on comparing the pay of employees within the same organization but in different jobs. Employees may compare their pay to those in lower-level positions, jobs at the same level but in different skill areas or product divisions, or higher-level jobs. These internal comparisons can influence employees' general attitudes, their willingness to transfer to other jobs within the organization, their motivation to accept promotions, their inclination to cooperate across different roles, functional areas, or product groups, and their overall commitment to the organization. The organization's choice of job structure directly influences these internal comparisons. Job evaluation is an administrative tool used by organizations to design and establish job structures that support internal equity. Considering both external and internal equity comparisons is crucial in determining optimal pay level and job structure decisions, as they impact employee satisfaction, engagement, and retention within the organization. Market pressures refer to the competitive forces that organizations face in the product market. In a competitive product market, organizations aim to sell their goods and services at a quantity and price that generates a satisfactory return on investment. While factors like quality and service are important, price plays a crucial role. The cost of production, including labor costs, significantly influences the price of products. If an organization has higher labor costs compared to its competitors, it may be forced to charge higher prices to maintain profitability. However, there are limits to how much an organization can increase prices due to product market competition. The upper bound on labor costs and compensation is determined by factors such as the share of labor costs in total costs and the elasticity of demand for the product. When labor costs make up a substantial portion of total costs and customers are sensitive to price changes, organizations face constraints in setting higher prices. Unless higher labor costs are balanced by increased worker productivity or desirable product features that justify higher prices, it becomes challenging to sustain higher costs in a competitive market. To ensure competitiveness and profitability, organizations often focus on cost-cutting measures, which may include reducing salaries or finding ways to improve efficiency and productivity. These efforts aim to reduce the cost of production and enable organizations to offer their products at competitive prices while maintaining profitability. Labor market competition is a significant challenge that organizations face in attracting and retaining talented workers. The availability of workers relative to the number of job openings can create labor shortages or surpluses, which in turn influence pay levels. When there is a shortage of workers in the labor market, organizations need to offer competitive wages and salaries to attract employees. The competition among companies to hire similar types of employees pushes wages upward as organizations strive to outbid each other for talent. This upward pressure on wages occurs not only within companies that have similar products, but also across different industries that employ similar types of workers. If an organization is not competitive in the labor market, it may struggle to attract and retain employees of sufficient numbers and quality. For example, if a computer manufacturer offers newly graduated electrical engineers the same pay as other computer manufacturers, let's say $2,000, but automobile manufacturers and other labor market competitors offer salaries that are $5,000 higher, the computer company may find it challenging to hire enough qualified electrical engineers. In such a scenario, the company may lose out on top talent to competitors who offer more competitive compensation packages. To remain competitive in the labor market, organizations need to carefully assess prevailing wages and salaries and ensure that their compensation packages are attractive to potential employees. Failing to offer competitive pay may result in difficulties in attracting and retaining skilled workers, which can ultimately hinder the organization's ability to compete effectively in the product market. Effective management of labor costs involves considering them as more than just a hindrance. While labor costs may be higher than those of competitors, they can be viewed as investments in the workforce. By providing high advantages and quality, companies can justify higher labor costs. Investing in employees through training and development can lead to higher returns for the organization. The type of employees a company chooses depends on its strategic focus. If the strategy emphasizes differentiation, such as creativity and innovation, highly qualified employees who can invent new ideas and products are preferred. These employees may be offered higher salaries to attract and retain them. Conversely, if the company focuses on cost leadership and routine work, less efficient employees may be chosen with lower salaries. It is important to recognize that employees are not only a cost, but also a valuable resource for the organization. Viewing employees as an investment can yield valuable returns. While controlling costs is important for competitiveness, cutting costs at the expense of employee productivity and quality can harm the organization's competitive position. Pay policies and programs play a vital role in shaping employee behaviors. They can encourage desired behaviors and discourage undesired ones. By designing effective pay policies, organizations can incentivize employees to perform well and contribute to the company's goals. When determining what to pay employees, organizations consider the competitive environment in which they operate. The range of pay is influenced by market conditions. However, organizations still have some discretion in setting their pay levels. The extent of that discretion depends on the specific competitive environment they face. In situations where there is a broad range, organizations must make strategic decisions on whether to pay above, at, or below the market average. The efficiency wage theory suggests that wages can impact worker productivity. When employees are paid more than what they could receive elsewhere, they are motivated to put forth effort to retain their good jobs. This theory highlights the idea that higher pay can incentivize employees to perform better and contribute more to the organization. Determining when the benefits of higher pay outweigh the associated costs depends on certain circumstances. For example, if an organization relies on technologies or structures that require highly skilled employees, paying higher wages may be justified to attract and retain the necessary talent. Additionally, if an organization faces challenges in observing and monitoring employee performance, offering an above-market pay rate can serve as an incentive for employees to exert maximum effort. Market pay surveys play a crucial role in compensation management as organizations strive to compete for talent. Benchmarking is a common practice where organizations compare their own practices against those of their competitors. In the context of compensation management, benchmarking is typically achieved through the use of pay surveys, which provide information on prevailing rates of pay among competing organizations. When conducting pay surveys, organizations need to consider several factors. First, they must determine which employers should be included in the survey. This involves selecting competitors or organizations within the same industry or labor market. Second, organizations need to identify which jobs should be included in the survey. They may focus on specific job families or positions that are directly comparable to their own. In cases where multiple surveys are used, organizations must determine how to weight and combine the rates of pay obtained from each survey. This ensures that the resulting data accurately represents the market rate. Various statistical methods can be employed to appropriately weigh and merge the data from different surveys. In addition to understanding market pay rates, organizations also need to assess the return on their investment in employees. This involves examining ratios such as revenues per employee and revenues per labor costs. The former ratio considers the staffing component of employee costs, but not the average cost per employee. The latter ratio, on the other hand, includes both the staffing component and the average cost per employee. By using market pay surveys and analyzing return on investment ratios, organizations can make informed decisions about their compensation strategies. Benchmarking against competitors allows organizations to stay competitive in attracting and retaining talent, while evaluating return on investment helps in assessing the effectiveness of their compensation practices. Rate ranges, also known as pay grades, serve as a framework for recognizing differences in employee performance, seniority, and training when setting individual pay levels. They provide a structured system that allows organizations to differentiate compensation based on various factors. In some cases, a single rate may be established for all employees within the same job. This could be applicable when the job does not require much variation in skills, experience, or performance levels. However, in many cases, rate ranges are used to accommodate differences within a particular job. Determining the appropriate market rate for a job is a complex task that involves subjective decisions. Once a market rate has been determined, it is typically used to set the midpoint of pay ranges for either specific jobs or pay grades. Market survey data is often collected not only for the midpoint, but also for the minimum and maximum rates of pay. This allows organizations to understand the full range of pay rates in the market and make informed decisions when structuring their compensation plans. Rate ranges provide flexibility for organizations to reward employees based on their individual performance, seniority, and training. Employees with higher levels of performance or experience may be compensated at a higher rate within the range, while those with less experience or lower performance may be compensated at a lower rate. This approach allows organizations to differentiate pay within a job and align compensation with the value each employee brings to the organization. Overall, rate ranges or pay grades are a useful tool in compensation management, enabling organizations to recognize and reward differences in employee performance, seniority, and training while maintaining a fair and structured pay system. In the context of compensation management, there are two types of jobs: key jobs, benchmark jobs, and non-key jobs. Here's a breakdown of their characteristics and how they are treated in the pay-setting process. 1. Key jobs, benchmark jobs. Key jobs have relatively stable content and are commonly found across many organizations. These jobs are often well documented and recognized in the industry. Market pay survey data can be obtained for key jobs, allowing organizations to benchmark their pay rates against industry standards. Benchmark jobs serve as reference points for comparing and setting pay levels for similar roles within the organization. Organizations may not gather market pay data on all key jobs to avoid excessive administrative burden, but they typically focus on key jobs that have the most impact on their compensation strategy. 2. Non-key jobs. Non-key jobs, on the other hand, are unique to organizations or have content that differs from similar job titles in other organizations. These jobs may not have clear industry standards or market data available for direct valuation or comparison. Due to their unique nature, non-key jobs require a different approach in the pay-setting process. Evaluating non-key jobs often involves internal job evaluation methods, which assess the relative value of the job within the organization based on factors such as job responsibilities, required skills, and internal equity considerations. Non-key jobs may be evaluated and assigned pay grades or salary ranges based on internal factors and the organization's compensation philosophy. Okay, how can we develop a job structure or pay levels? Developing a job structure involves job evaluation, which is an administrative procedure used to measure the internal worth of jobs within an organization. Here are some key points about job evaluation and compensable factors. Job evaluation. Job evaluation is a systematic process that assesses the relative value and worth of different jobs within an organization. The purpose of job evaluation is to establish a hierarchy or structure of jobs based on their relative importance and contribution to the organization. Job evaluation helps in determining appropriate compensation levels, internal equity, and establishing fair pay differentials between jobs. It involves analyzing various factors and characteristics of jobs to determine their relative worth. Compensable factors. Compensable factors are the characteristics or attributes of jobs that an organization considers valuable and chooses to compensate for. These factors represent the key dimensions of a job that impact its worth and are typically identified through a job analysis process. Compensable factors can include job complexity, required education and experience, responsibility level, working conditions, skills and knowledge required, and other relevant factors. Each organization may have its own set of compensable factors, depending on its industry, business strategy, and job requirements. Weighting scheme. Once the compensable factors are identified, a weighting scheme is developed to assign relative importance or weights to each factor. The weighting scheme reflects the organization's priorities and the significance it places on each factor in determining job worth. The weights assigned to each compensable factor are used to calculate a total score or point value for each job, which is then used to establish its position within the job structure. Involvement and input. Developing a job structure through job evaluation typically involves input from various stakeholders within the organization. These stakeholders may include HR professionals, job incumbents, supervisors, and managers who have knowledge and understanding of the jobs being evaluated. Input from multiple perspectives helps ensure a comprehensive and fair assessment of job worth. The point factor system is a common method used in job evaluation to assign values or points to compensable factors and determine the relative worth of jobs. Here's a breakdown of the two approaches for assigning weights in the point factor system. A priori weights. In the a priori approach, weights are assigned to the compensable factors based on expert judgments or subjective assessments of their importance in determining job worth and compensation. These weights are determined by individuals or a committee who have knowledge and expertise in the organization's job roles and compensation philosophy. The assigned weights reflect the organization's priorities and value system in terms of the importance placed on each compensable factor. A priori weights are often used when there is a lack of available empirical data or when subjective judgments are considered appropriate for the organization's specific context. Empirical weight. The empirical approach involves deriving weight based on objective data and statistical analysis of how each compensable factor influences pay in the labor market. This approach relies on gathering market data, such as salary surveys or external pay data, to examine the relationship between compensable factors and actual pay rates. Statistical methods, such as multiple regression analysis, can be used to analyze the data and determine the relative importance or weights of each factor in predicting pay levels. Empirical weights provide a more data-driven and objective basis for determining the importance of compensable factors in the labor market context. Both approaches have their merits and may be used depending on the availability of data, organizational preferences, and the level of sophistication desired in the job evaluation process. A combination of a priori and empirical weights can also be used to balance expert judgments with objective market data. Market survey data is an important source of information for setting pay rates in organizations. Here are some key points regarding the use of market survey data, the pay policy line, and pay grades in pay setting approaches. 1. Market survey data. Market survey data is primarily focused on external comparisons and provides information on prevailing pay rates for key jobs in the labor market. This approach places the greatest emphasis on comparing the organization's pay rates to market rates to ensure competitiveness and attract and retain talent. Pay rates for key jobs are directly based on the market survey data, which covers as many key jobs as possible. By aligning pay with market rates, organizations aim to remain competitive and ensure external equity. 2. Pay policy line. The pay policy line is a pay-setting approach that combines both external and internal comparisons. With the pay policy line approach, actual market rates are no longer used for key jobs. Instead, pay rates for both key and non-key jobs are derived based on a pay policy line that is linked to the organization's internal job evaluation points. The pay policy line establishes a relationship between the job evaluation points and pay rates, providing a greater degree of internal consistency in the pay structure. This approach allows for a more standardized and internally equitable pay structure, irrespective of market fluctuations. 3. Pay grades. Pay grades are another pay-setting approach that categorizes jobs into groups or grades based on their relative value and worth within the organization. Each pay grade typically has a range of salary levels or rates associated with it. Pay grades provide a framework for establishing consistent pay levels for jobs that are similar in terms of their internal value, responsibilities, and required skills. While pay grades may consider market data as a reference point, the emphasis is more on internal comparisons and maintaining internal equity. Pay grades involve grouping jobs of similar worth or content together for pay administration purposes. Here are some key points about pay grades and range spread. Grouping jobs. Pay grades involve categorizing jobs based on their relative value, worth, or content within the organization. Jobs that have similar responsibilities, required skills, and job content are grouped together within a pay grade. The purpose of grouping jobs into pay grades is to simplify the pay administration process and create consistency in pay levels for jobs that are deemed to be of similar value. Rate range. Within each pay grade, There is a rate range that defines the minimum and maximum pay levels for jobs within that grade. Each job within the same pay grade is assigned the same rate range, meaning the pay levels may vary within that range based on factors such as individual performance, experience, or tenure. The rate range provides flexibility in setting pay within a grade while still maintaining consistency and fairness for jobs of similar worth. Administrative efficiency. Grouping jobs into pay grades reduces the administrative burden of setting separate pay rates for each individual job within an organization. Instead of setting unique pay rates for hundreds or thousands of jobs, organizations can focus on establishing pay ranges for each pay grade, making pay administration more efficient and manageable. Pay grades help streamline the process of job evaluation, market pricing, and pay determination by grouping jobs with similar characteristics together. Range spread. The range spread represents the difference between the minimum and maximum pay levels within a pay grade. The range spread may vary based on factors such as the organization's compensation philosophy, market conditions, or the level of the job. Generally, the range spread tends to be larger at higher pay grades, as jobs at higher levels often have more significant responsibilities and require higher levels of expertise.
Thank you for watching. If you liked this video, please like and subscribe to channel.